to introduce themselves so that they do move on to our questions. So Greg, why don't we start with you?
Thank you, Chair. My name is Greg Wheeler. I'm a director of Savills, and whilst our brand can sometimes go before us, we're quite well known for selling country estates. The division that I set up and head up is exclusively to do with social housing and in particular stock condition surveys and wider property advice within the sector.
Short and sweet, thank you. Do I need to? No, I don't. Right, well, as you've heard, my name is Martin Watkins. I'm a director within Capita's Property and Infrastructure Division, or company I really should say, and I head the Housing Finance and Consultancy part of that organisation. That's titles, they mean nothing. I think you'd probably be more interested to know in a little bit about what we do and how it relates directly to this commission. Well, just to set the scene, the Housing Finance and Consultancy team currently provide HRA business planning tools and support to just under 1/3 of all the local authorities in England that still have housing stock, and we also provide business planning and or ongoing funding support to just under 50% of the top 250 housing associations in England. And that includes a substantial number of stock transfer organisations, some that we helped create, some that we had no part in. Keith mentioned earlier that over the years there have been hundreds of option appraisals of this kind undertaken by local authorities, and that's absolutely true, and I've personally been an advisor on 50 or 60 of them. I've also been a lead advisor on 40 plus now stock transfers, which gives you a fair old clue as to my age, so we won't go any further with that one. My personal interest really is a very keen one in complex regeneration initiatives. So for all of those reasons, I and my colleagues are really delighted that we've been selected as the financial advisors for this study. I could tell you lots of other things that we do, but I think hopefully that's given you a flavour of really the direct relevance to what you're engaged on now. And I will finally say this, although there have been hundreds of such studies over the years, and quite a number actually going on even as I speak, this is by far the most open and transparent one that actually I've ever been engaged in. I think, never mind currently engaged in. The approach to this is more rigorous and open and engaged than any other that I can recall.
Hello, I'm Rowan Lemond. I'm CAT's equivalent at Brent Housing Partnership. We're a slightly different organisation in that we're both an ALMO, and we're still existing as an ALMO that manages Brent stock, but we also manage our own stock, and we've got a mix of tenure types running from market rent to social rented properties that we own in our own right as an RP, so we can see both sides of the equation. I think this is where I can be make a confession. I actually worked in Hammersmith and Fulham many years ago as a trainee in the housing department. And I was actually involved in the Old Oak transfer fund. The estate regeneration funding was done on the Old Oak estate, and that was transferred to Family Mosaic. So I've worked on both transfers with tenant management organisations and now as an RP, so I've got a bit of experience across the board.
Ryan, thank you very much for that. The way we're going to deal with questioning here is we're going to pursue a line of questioning, first of all, with Greg and Martin, and then we're going to move on separately to pick up 2 or 3 issues with Ryan. Thanks very much indeed for your kind remarks, Greg, about the nature of proceedings. It's quite a responsibility that we feel in what we're doing here, but we're absolutely certain it's the right approach to pursue. So, without further ado, I'm going to ask Sophia to ask the first question in this session.
Thank you. Great, this one is for you. what are we looking at in the present stock condition survey, and what scope is there to set new standards of maintenance and improvement?
Thank you, Sue. Firstly, I feel like I did my introduction, I sold myself short on my introduction there. You've got the short version for me, which you're probably quite glad about. Thank you for the question. I'm conscious that in the previous session we actually sort of touched on a lot of little bits to do with stock condition surveys, and hopefully I'll be able to sort of join those up for you in answering this question. And really it's a tale of two halves, as is the question. So the first half specifically about the stock condition survey itself and the mechanics of that. To try and demystify that, and I'll try desperately to stay away from buzzwords and technical speak, really it's about visiting a very targeted percentage of the stock that Steve was alluding to that covers all of the archetypes, which I won't cover in depth now unless you really want to hear. But crucially, it's about a surveyor taking a professional judgment on how long various elements of the property will last and when it needs to be replaced. And that really is the key to it. So a sort of small example of that will be a kitchen. He'll have a preconceived idea of roughly how long a kitchen lasts before it's beyond economic repair, i.e. it's not worth repairing, it needs to be replaced completely. But then he'll take into account the outside factors, the usage, the abusage, the level of the quality of workmanship, of installation, and form a professional view and say that kitchen needs to be replaced in 2 years' time, 5 years' time, 20 years' time, whatever. That really is the core of a stock condition survey. So the first part of it is for us to come up with, if you like, a price tag of saying how much to replace your existing elements based on the surveyor's professional opinion over the next 40 years. And that's what they're currently doing out on site at the moment. The second part of the question is a slightly more tricky subject, because that's quite a nice, hopefully concise answer, that it's all about bricks and sticks and technical opinion and pieces of data that we can sort of broadly understand. When you start moving into standards, you start coming into the sort of second area of our overarching brief, which is to try and come up with a total investment need of the stock, of which the stock condition is one part of. The other parts of that generally fall into two categories. One, the sort of running costs of the stock, your ongoing day-to-day maintenance, your cyclical servicing of boilers, repairing properties, your turnover void cost, the sort of costs you can't run away from, needs to be factored in. And then there's the sort of slightly more ambiguous area of improvements that I think covers the standards issue of you're talking about. And there was already some classic examples of those mentioned within the first session. There was CCTV that was mentioned, that would be a classic improvement. It doesn't fall under the scope of the survey because we can't say what condition it's in because it doesn't exist. So by de facto it's an improvement. There was also insulating solid walls was mentioned, which is another classic improvement. And there was the sort of more ambiguous, wider environmental improvements. And they sort of quite nicely sort of firm our categories of improvements, because some of those are evidence-based, and we'll be coming back with some of those from the survey, of saying, in our professional opinion, these solid walls, we think you should allow some money to increase the thermal efficiency of those walls going forward for the stock if we're looking over 40 years. Professional judgment and to a degree just good common sense. That will extend to things like installing central heating where it doesn't exist, putting smoke alarms in, but again, still a technical type of need. We're then into the sort of non-evidence-based ones, where we've got a reasonable idea of what they're likely to be, and that's very much famous last words based on experience, but we also lean heavily within the ITLA, with the engagement that you're doing with residents, to see what's important coming back. So if, for example, security or environmental improvements are an issue, they're not particularly tangible, they're not very easy to put on a spreadsheet and cost them, but we can acknowledge them and say, well, we've allowed X amount of pounds to undertake a degree of this work to try and compensate for it. And that really is a bit of a sort of top to tail. One final point that I think was within the question is about standards, because that's very much about provisional standards. But you're also talking about the service standards. And service standards, again, can be very difficult to quantify. And really the simple answer is the amount of money that you currently spend providing that service. If there's quite a groundswell that that's inadequate, and people would like a 5-star service or a much better service. Sometimes that can't be quantified, but it can certainly be provided for financially. When we say we have to provide a better service, generally costs more money. Of course there are efficiencies to look at, but generally it costs more money. So we can apply some extra money within there if a greater service is required. So hopefully that covers the key points within your question.
Thank you.
Andy, I think you probably have a supplementary on that.
Yeah, I agree. I'd like to ask about 4 aspects that you haven't mentioned in the stock condition survey. I'd like to ask, do you take into consideration previous resident feedback, such as the volume of complaints about the last major works, current contractor problems, such as the fact that the repairs contractor at present is having huge issues with drainage, renovations, so where leaseholders are taking upon themselves to change the state of their properties, and changes in occupancy. So, for example, we've got a vast number of one-bedroom properties that originally were one bedroom, one resident, but now have 2 adults, 2 children in them.
Okay, thank you. You'll have to forgive me if I get those questions slightly
Sure,
out of order,
we'll
or indeed, my power of recall is not what it used to be. The simple answer is yes, on everything that you've raised there. But it really is about trying to quantify things. Our remit is very much to be very defendable and accountable for every sort of line of investment that we come up with. So rather than just be a faceless line, we like to provide a logic for where that line has come from. So certainly for associated consultants, wider audiences, when someone says, well, how did you come to that? Even if it's our best estimate, there's a logic behind it. Now, some of the areas you mentioned there are not very quantifiable, particularly resident feedback on sort of current contractors, and we don't necessarily need to expand within this arena. But I spend a lot of time doing that exact sort of issue, sort of call groups with contractors, and a lot of the time the things that come back is a big wave of people being unhappy, but it's actually, well, the workman didn't wipe his feet as he came into the door. Could be at one end of the spectrum, and the other end of the spectrum is he finished putting the heating in and walked out and the boiler fell off the wall, and anywhere in between. So it can be very hard to get that out. Certainly things on quality of workmanship I'm particularly interested in. Very interested on previous resident feedback. So we will take all of that into account. I think you also touched on almost an overcrowding issue by the sound of it, sort of 1-bedroom provision. And renovation. So is that renovations where the resident maybe is undertaking that work themselves?
That's right, yeah, where leaseholders have substantially changed the usage of a property, but that property itself is not necessarily representative of the block or the estate. Okay, well certainly on that point firstly, we're not visiting the insides of leaseholders' properties, we're just covering the outside of them. On the sort of potential overcrowding issue, we're also carrying out a housing health and safety rating system, which is a bit of a mouthful, which is referred to just as HHSRS, where overcrowding is one of the categories that we're asked to consider within the property. So if we think there is a large over provision, particularly if it starts to get to the point of being prejudicial to health, then it's under our responsibility to report that back to you.
Anything else?
That's great for now. Thank you.
Shall we move on? I think Anthony Wood has the next question.
Thanks. This is for you, Martin. I don't know if you heard the question I asked Kath just before the break. It's really the same question, which relates to new government legislation which is going to extend the right to buy to housing association tenants. And it's really further to what she said. What for you are the implications of sales of high value void properties to the HRA?
Thanks, Anthony. Happily, Kath gave a very comprehensive, very good answer to that question, I have to say. It's really quite difficult to think of much of any substance to add to that answer. Few observations. We know that the government, as now is, and when it was the previous government, heralded a number of policy changes, which are in some way joined up. The first was the extension of right to buy to housing association tenants. The second is the sale of local authority high-value voids. And the third part of that is some contribution from government, all to the ultimate end of the development of new social stroke affordable housing. What none of us know is quite how those are intended to join up, or indeed as yet, what the detail of each of the components will be. How is it really going to work? And we won't know, at least until the housing bill is published, and maybe not even then. I am told, however, that in fact it was Keith earlier on, that the housing bill may be published tomorrow. So this answer may be overtaken by events very quickly indeed. But the key point is until that is produced, and possibly not even, the devil will be in the detail as always, we don't really know. I think it's fair to say that not just in London, but in other parts of the country too, local authorities are reacting with considerable anxiety to the potentially forced sell-off of high-value properties for all the reasons that Kath articulated. I think too, it's not such a great leap to make, and this maybe is an additional comment, that the highest value properties are probably not the properties in the need of most investment. And that if a housing revenue account is divested of those properties and the proceeds from their sale are not available, either by way of direct investment or debt repayment, for reinvestment in the existing stock, but instead for new development, possibly by housing associations, that what the authority is left with will actually have a kind of lower value per unit than what it had before those properties were sold, and at a residual housing revenue account level, whatever resource and investment constraints there were will now be greater. I think hopefully that's addressed the question. Let's really wait and see what the bill and whatever comes out subsequently says.
Thanks for that, Martin. I turn now to Lorna, who I think has another question for you, Martin.
Okay, Martin, so a few questions actually. How do stock charitable landlords approach the investment needs of their stock? I'll ask that to you first.
That's another really good question, thanks, Lorna. Well, they will start from the same basis that is being approached within the context of retention, and on the same basis that Greg's outlined, which is an up-to-date stock condition survey with a clear professional opinion on the long term, and by that we mean 30, 40 years, repairing and improving and maintaining obligations in the stock. The fundamental difference between a local authority and a housing association in this respect comes from them being different animals and how their resources are, in the one case, regulated and constrained, and the other case not. Local authority is a public sector body, as Kath explained earlier. Its ability to fund capital expenditure housing capital expenditure is limited by the debt cap, which came out of the self-financing settlement in 2012. Housing associations are, for these purposes, it gets pretty mixed and or confusing in some other contexts, but for these purposes are private sector bodies. And their borrowing is not constrained, subject only to them being able to satisfy the regulator, which is the Homes and Communities Agency, and their funders, that they have long-term viability and sustainability. But that is the fundamental. In that sense, they have no externally imposed resource constraint, and are therefore freer to formulate their asset management investment strategies accordingly. That also gives them the luxury, it has to be said, of government funding is limited to achieving and maintaining the decent home standard. Much more difficult to extract cash for aspirational levels of what you and I might call decent over and above that. Housing associations aren't constrained in the same way. If they can attract the resources, that they have the resources, then they can look within their plans for aspirational standards that are higher.
Okay, so that's quite interesting. So you're saying that housing associations have scope to go beyond just basic repairs in a sense. That's what you're saying.
Within the limits of their business plans, yes, but those limits are not regulated in the same way. They have more freedom. They still have to be able to afford it, as does everybody else, but they're not constrained in quite the same way. So.
Okay, so I mean, just obviously, if we look at stock transfer landlord, whether that's housing association or local authority, how do they set standards to ensure that their stock can meet the needs of those they house, basically? Is there a difference between the two? Can you point that out as well?
Can I think about that one for a little more? Greg, do you want to, in terms of standards on stock, would you like to say something on that one? And I'll pick up on your parts.
Very smooth palm off from Martin there, I think. Standards are a very, very tricky thing because they start off usually quite simple and they get very complicated very quickly, and the devil's very much in the detail. Generally, where most existing RPs or transferring organisations go is certainly there's a big intent to have a standard because they see that as one of the sort of big markers of the difference in the organisations, and they're very, very keen as they should.
Sorry, I'm just finding it a little bit hard to concentrate, so I can hear you sort of switching. That's how we know. Okay. That's why we talk. All right. Okay. Thank you. Sorry.
And they sort of want that to be the differentiating factor, if you like. So they generally start off with an age-based type of criteria. And what I mean by that is over the key elements of saying to residents, listen, every 15 years, every 20 years, you'll get a new kitchen, for example. And that's part of our standard. We don't want old, tired kitchens within the stock that are constantly being maintained. We're better than that, and our standard's better than that. And that's a very common direction of travel that standards tend to go in. The reality of it is that a lot of those comments often end up with, we'll replace a kitchen every 20 years where needed, where finances allow, and the devil can be sort of in the small print of it. That's the general rule of setting standards, because if it's anything much more complicated than that, it can be a very difficult thing to understand about what it really means to the people it actually applies to. So that's generally the way they go for setting standards. The second part of the question about how they then address the sort of future needs of the stock is almost an unanswerable question, and that's not just a polite way of saying I don't know, but I don't know. They'll rely heavily on their existing housing needs surveys, the changing demographic statistics of where things are going, and they'll position themselves where they should try and position themselves, which is to house the people that they have in their target audience. I appreciate that's a fairly ambiguous answer, but it can't really go any further than that, I'm afraid.
So in some ways there's some emphasis to get the standards at least able to meet the needs at some basic level.
Oh, very, very much so. Very much so.
Working that out quite really difficult.
Again, very much.
So, I mean, you said you kind of answered my last part of the question about, how they find the investment they need. I think you kind of covered that, haven't we, really? Is there anything else you wanted to say on that in terms of funding, in terms of things that you've done on tenant houses? Or markets?
Well, I think it's kind of the link back to the previous question in many ways. It is about housing associations' finances are constrained more in the sense of being almost private individuals, but living within your means and satisfying your regulator and your funders that your business plan is prudent, sustainable, and all of that. But those are really the only constraints. They are under increasing pressure under a new regulatory regime to improve value for money and all of these things and try and free up resources for reinvestment. But the whole thing about standards goes, it's across the whole range of services that they provide with authorities, not just the sort of physical condition of the stock. And like others, they will listen to what their customers, residents, have to say in respect of their own priorities, and by and large try and take those on board. But it ultimately all comes down to one regime is very much constrained, the other regime not totally unconstrained, but in a very different way, which provides more freedom.
And I think you have supplementary, which might help us in this.
I do, thank you, Chair. Related exactly to this point. So playing back to you, Martin, what you were saying about housing association borrowing. So a council is artificially constrained by a rule from the Treasury about how much it can borrow, whereas housing associations can go out to the market and borrow freely, but within their means. So I think we get that. However, there is a difference in funding costs between the two, is my understanding. So can you comment, please, about the differential interest rates that councils and housing associations might be paying to access that borrowing, as the market is at the minute, for example?
Yeah, happy to do that. As you heard from Kath earlier, local authorities, although there is some existence of market debt, which is debt sourced on the private markets nationally, it pales into insignificance against the Public Works Loan Board debt, PWRB for short, where university local authorities now go for all of their borrowing requirements. I do happen to get a daily sort of e-bulletin telling me what the PWRB rates are, and Kath was pretty much spot on. The current rates for 40 to 50 year money are around 3.5%. Housing associations don't borrow from PWRB, they borrow from either the banking sector or increasingly these days what's called the capital markets, which are institutional investors, insurance companies, pension funds and the like. There has been interest rates generally in our sector are at an historic low, reflecting where we are with interest rates generally. But the differential between local authority borrowing rates around 3.5 and housing association borrowing rates is right now pretty small. Hardly a week goes by without a report of one or other housing association issuing a bond, and the trend has been for them to be ever more attractive rates. We've had a couple which essentially are below government borrowing rates. There's no hard and fast rule about this. I mean, in approaching the markets, funders will form a view, sometimes aided by credit ratings provided by the rating agencies as to the effective creditworthiness of these bodies. They'll form a view on the financials, they'll form a view on the governance and management competence of the body, of its size and its track record, and will offer to lend accordingly. There's a relatively narrow spread in terms of recent activity of what those rates are, but just because one housing association borrowed at, let's say, 4%, doesn't mean that the next one will. It may be slightly less, it may be a little bit more, depending on all those factors. But in the context of the question, Anthony, it's right now there is a relatively narrow spread. There is also increasing interest in local authorities using their general fund prudential borrowing powers, which are not constrained in the same way as housing debt is constrained, to borrow and on-lend to housing associations at potentially more advantageous rates than those associations could borrow in the private market. Kath also earlier mentioned state aid rules, and there is an element of that which has to be considered. You don't want into problems where you're perceived effectively to be offering an unfair commercial advantage, and so there has to be some sort of correlation between what authorities could lend at and what the market would offer. The irony in that is that the mere means of doing that, and what's generating interest in local authorities, is it means they have to make a margin. If they borrow for 3.5% from PWRB, they would on lend at 4.5, 5 for the sake of argument, and it's the council would benefit from the uplift on those. So there's kind of advantage all around. And that's something that's there's a growing consideration of in the housing sector.
Shirley and then Anthony. Shirley first.
Thank you.
This is a question I'm hoping that one of you can answer. In terms of funding, obviously for both councils and housing associations, one of the ways that they fund their activities is through rents. And it's generally understood, I think, that housing association rents tend to be higher than council. Is that inevitable, or is it a matter of choice for housing? In other words, could you form a housing association where rents stay comparable to council rent and get your funding from elsewhere?
The short answer to that is yes. Do you want a slightly longer version of that? There was a time when that statement was not just very widely held, but would have been pretty accurate. And this goes back to, actually you'll probably put me right on this, maybe 2000, the introduction of rent convergence and target rents by government, which the underlying philosophy of that was, if a tenant lives in a similar property, in a similar location, he or she should be paying the same rent irrespective of who the landlord is. And so the process of rent convergence to what were called target rents was introduced both for local authorities and housing associations on a formula based around local earnings, capital values and heaven knows what. As of this year, last year, that all came to an end and both housing associations and local authorities are now effectively governed by housing associations, certainly by a new rent standard, and government policy applying to both sectors is that rent should rise by no more than the consumer price index plus 1% year on year. And that was a change from the previous policy of retail price index, which was higher, plus 0.5%, plus or minus £2 of this convergence criteria existed. Rents should be directly comparable under either scenario is back to the short answer in either case.
And then I've got Anthony, and then Andy. I'm getting quite conscious of time, and we've still got a lot of questions to ask to Rowan. So,
Martin, I was going to ask this supplementary question to Rowan, but seeing as we're talking about financing, I thought I'd pitch this to you. This is worst case scenario. Supposing a stock transfer landlord got into serious financial difficulties either by overstretching, overborrowing, interest rates went somehow, whatever. What safeguards are there to prevent the new landlord from going bust?
That's quite a big question. Housing associations are no different to local authorities in the sense that technically either could go bankrupt. The regulatory regime is very much geared to prevention rather than cure in that sense in the housing association sector, although there have been some pretty high profile cases of housing associations getting very close to the wire, of which some of you no doubt will know the Cosmopolitan saga of recent times, which resulted in a further tightening of the regulatory regime. Housing associations are subject to a very rigorous regulatory regime by the Housing Corporation, Homes and Communities Agency, I'm still talking old money, which is all about risk identification, risk management, risk assessment, and have to make frequent periodic returns of their business plans and financial forecasts to prove their ongoing viability. So the Homes and Communities Agency have step-in rights at a very early stage if things are starting to go off track, whether financially or through sort of governance failures, for example, because they're rated on both. What would happen in the case of an association that's causing concern? It would be an alert in the first instance. There may be direct intervention in which the Homes and Communities Agency would replace some or all of the board members and executive staff. In slightly more extremists, there would be potentially a forced merger with a larger, more viable, sustainable organisation. What it wouldn't be allowed to do is go to the wall. The funders of housing associations likewise have rights. I mean, technically it's called mortgagee in possession, which is if you or I have a mortgage and we don't pay it, the bank can take over our property. The banks and funders of housing associations have similar rights. The very last thing on earth that they want to do is be the owners of stocks of residential property. So, although technically that's a possibility, what would happen is one of the earliest steps. Intervention by the regulator, ultimately potentially replacement of executive boards, and or potentially an enforced merger all with the aim of ensuring that the customers of the association continue to enjoy the standards and service and rights that they've come to expect.
So they would have safeguards, they would be safe.
Oh, very much so, very much so.
Fine, thank you. Very conscious of time now. Last question from Andy to Martin.
Hi, Martin.
Andy,
I have a leaseholder's question. Could you sum up for us what is the position of leaseholders and how would they be affected, I guess, if the buildings in which they hold a lease are transferred to a new landlord and included in an investment program?
Thanks. That's another one that Kath gave a really comprehensive answer to earlier, and it was a dead right answer. There is no one-size-fits-all answer to this question, I've got to say. You could start with the generalisation that if stock is transfers and there are leaseholders in a block, for example, and that major repairs and improvements are to be carried out to that block, then leaseholders are in for their share of the bill. That is a generalisation. The caveats to that are a number. One is precisely what, if anything, leaseholders or any individual leaseholder may be liable for. To answer that, you have to look to the terms of the lease. I've come across within the same council examples of leases where actually their liability in that respect was effectively bought out as part of the right to buy price in the first instance. In others where absolutely the opposite is the case. So the terms of the lease are pretty important in that respect. The second is, and that's assuming that caveat doesn't apply, is really down to what can reasonably be expected by way of a contribution, having regard to the circumstances of the leaseholders. And even in that respect, and I won't quote the number because it's changed recently and I'm slightly unsure of that number, there is a cap on what a transferring landlord can be expected to recover from any given leaseholder over a period of 5 years, I think. So there are checks and balances, but as a generalisation, yes, on the face of it, leaseholders would be due for their share of the cost of major repairs and improvements to their block.
Okay. Good. Martin, Greg, thanks very much. Please stay in position. We're just going to now move to a series of very important questions to Rowan, but thank you very much indeed. And I'll come back to say a big thank you in due course. So our first question to Rowan is from Matthias. Matthias, over to you.
Rowan, thank you. Can you tell us how the funding works for stock transfers and what questions we need us to satisfy ourselves that transfer could be not just a viable option for our board, but a desirable one?
Well, I think the list of questions could be absolutely endless. I think in terms of the stock transfer, to satisfy yourself, it's actually about getting to understand what some of those covenants are likely to be. I mean, the way that stock transfers tend to work and have worked in the past, and I think the latest one went through last month in Durham, was that a valuation is put on the stock which takes into account the need to do some of the work. Now, you talked earlier about the decent homes and about the decent homes being funding for some types of work but not everything. And the stock valuation model and the calculation of valuation is exactly the same. it will assume a level of repairs and work that needs to be done. That may not match up with what your standards are. So that's the first type of questions you need to be asking. What is it being the assumption in the valuation model against what your assumption is in your stock model? Because it won't necessarily enable you to fund. And I think when we said about the caveats that lenders put in, of course they will only lend so much. And one of the issues that you might have is about some of the caveats that they will then put into you. I mean, I think the Durham one was quite interesting because they actually had some of the loans being done at a repayment, an annuity, which is what you would expect if you do your own mortgage. Some of it was done at interest only to be a spot payment later on. Now, you've then got to make sure that you can provide against all of those. And I think lots of the questions you need in terms of stock transfer is it the best thing for you? Is it the way of getting that funding in? And I think some of the work that you've been doing about working out exactly what it is you want to do with the stock, once you know what it is you want to do with the stock, it then makes it easier to decide what option you want to take in order to do it. I mean, I think some of the issues that I have with Brent Housing Partnership is we have a number of different models of funding for the stock, because some of our stock was transferred from the council, others were new build. And we've therefore ended up with a portfolio with lots of different caveats and lots of different funding arrangements, not necessarily in terms of the loans, but in terms of any grants that we got. Because I think that's also one of the other things you need to look at. You've asked questions about levering in other funding sources. As I think Stephen said, there's no such thing as a free lunch when it comes to other funding sources. You either have to pay money yourself, or else you've got caveats on that funding. And then it's an issue about, do they fit in with what you want to do with your stock? And I think the standards that you set can be quite interesting. Again, because of our stock nature in terms of our own RP stock, we actually have different standards. I mean, everything you've referred to so far is about having the same standard. We actually have different standards across our stock types. And that's partly because, as an RP, we can use them to cross-subsidise. So where we've got market-rented stock, we have a completely different standard for the maintenance of that and for the interiors of it. So we will fully furnish, we will carpet, because that's what people expect if they're effectively paying private rented sector rents. That's not the same standard we'll provide in terms of the affordable or the social housing. And I think that's one of the things you really need to think about, what type of housing you're going to be providing. You asked the question about, the social rent. In our case, a decision was taken that not all the properties would be at the social rent, because that allows us to do so much more with the other stock.
Can I just ask a supplementary to that, and that is, are there circumstances in which a stock transfer company would inherit quite significant financial burdens from the predecessor authority?
Virtually all of them, I have to say. Even the Durham model, I had a quick look at that. Even the Durham model, the majority of their borrowing, I think it was about £150 million that they borrowed. The majority of that, I think around about 110, 120 million, was actually a repayment to the council to pay off the debt. That is therefore debt that they're having to fund in the same way as Kat talked about the debt you've got in your current business plan. Only about 30 million of the funding that they raised was for investment in the stock.
And I think I might be saying in the past, I may have done it myself in the past, that government used to be quite helpful in facilitating the reduction in some of those debts inherited by stock transfer companies. But that situation of government assistance has more or less dried up.
Well, the Durham one did have government assistance, because I think the total debt was over 200 million. So there was still some government assistance in that, but that was part of the 2013 round. However, there have been talks that that will continue going forward. CLG keep threatening to publish more documentation of how they're going to take that forward, which we think will come now that we've gone past the election. There was also a consultation shortly before the election, which was about how could stock transfers be enabled to free up more funding, which a lot of that is based on the fact that the funding that they already have is based on the valuation of the stock. Now, if you start changing the valuation of the stock, you start causing problems with your other funders, and you start making your business plan a bit more dodgy.
Rowan, again for you. What scope, a similar question to what we asked about what councils could do, but via the stock transfer models, what scope is there to leverage in other sources of funding for improvements and service developments, such as, again, the green agenda or other things?
I think in some instances there's a lot more scope. And it also can depend on the type of organisation that you transfer into. For example, if it becomes a charity, it's got completely different scope from non-charitable works. And I think especially in some of the areas you touched on earlier in the first set of questioning about the more social aspects of housing work. And I think Kat was right when she said about not being able to use the HRA money for certain functions. There isn't that constraint on an RP, whether it's a voluntary transfer, whether it's been set up in a different way. They don't have those constraints, so therefore there's a lot more funding they can go for to enable them to support different residents. I think on things like green funding, the same proviso. Yes, there is scope there, but you have to pay for it. And there's also the issue about if you've gone through a transfer based on a certain level of service and a certain level of standard, where do you get your part of that funding from?
Can you just give us an example? You said charity, if it was formed as a charity, it would have access to different things, and if it wasn't, are you able to give us just one or two tangible examples?
Some of the things like big lottery funding, some of the charities have actually charitable housing associations have managed to get funding through the big lottery, which again, we can't refer to state aid, isn't always available when it's council. And I mean, we can see, as an RP, we get caught somewhere in the middle of this, because we're still an animal 100% owned by the council, even though we own our own stock. So for certain funding arrangements, we fall under the state aid, but for other ones, we don't.
And now, I'm afraid, probably our last question, I turn to Andy.
Hey, Ron. Further to the evidence we were going to hear from Martin, my question is, what is the role of funders with respect to the governance and financial decision-making of stock transfer organisations?
It can be huge. And I think some of the funders, and I'll give you some examples of where we've had decisions that are going to be influenced by someone external. And it's not necessarily just funders. Because we've got some new build, we also had grant funding. Now, some of that grant funding, then in conjunction with the covenants on the lease, on the borrowing, means that you end up being very, very constrained with what you can do. And in our case, we have some properties that the arrangements are such that by the time we get to year 15, we're going to have to consider other things to do with that stock, because the covenants that have been put on it actually stop it being viable in terms of the model that we've set up. And I don't think, and that's why I was saying about some things about the questions can be endless. It wasn't something that was thought of at the time that the deals were entered into. It was only something that's come out later as things like RPI and CPI change, and as borrowing changes, it starts having a knock-on effect. So something that was a good decision 10 years ago might not be a good decision in 5 years' time. So I think it's always about being prudent and about being careful about those covenants and actually making sure that you understand what they are. I mean, some of ours are incredibly simple. We have covenants where all we have to do is manage the cash flow and make sure that when it gets to the period where we make repayment, we have the money to do it. We can't go overdrawn to make that repayment. But other ones can be incredibly complicated.
Well, ladies and gentlemen, I think we've come to the end of our fourth public hearing, and again, it's been an invaluable and fascinating session. It falls to me at the end of these sessions to summarise the proceedings, which of course is an impossible job, but a couple of thoughts do occur to me. One is, I think, that we learned from the first session about the sensitivity of the business plan for housing in Hammersmith and Fulham against the backdrop of possible new legislative demands on expenditure, environmental issues, health and safety, the whole impact of high value void sales, leads you to the thought, possibly, that there is a risk that we may have to take into account of the plan falling over, which is on reflection, on the quality of work done by our officers in Hammersmith and Fulham, but simply a reflection of the new world of social housing and the new demands on social housing and to some extent the depletion of stock. By contrast, what we've learnt is that with housing associations there is apparently greater scope for borrowing, for investment, but what we've also learnt is that transfer is not entirely a free pass, or I think, to quote Roanne, a free lunch, because we need to be sure that there's going to be adequate funding for the needs of the stock in the future. One consequence of the situation may be different standards to be applied to different stock, and also to take into account is that, yes, you may have greater scope for borrowing, but part of that borrowing may be to pay off debt, and that is a further consideration that we will need to bear in mind as we go forward. But in the meantime, I want to say a huge thank you to Greg, to Martin, to Roanne. It's been a fascinating and important session to you. We're immensely grateful to you for giving up your time, and we'd like to, in concluding our meeting, thank our audience as well for their patience and interest and commitment. We're beginning to recognise some of the faces attending these sessions, so may we express our thanks to our witnesses and to our commissioners, and indeed to everybody in the usual fashion.